Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the June investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market and the investment universe that you need to know right now. Bob and I are going to talk about performance in May, valuations, some thoughts on residential real estate, and stock split article that we found pretty interesting that we wanted to dive into. So, Bob, welcome back to Wealthy Behavior. How are things going?
Thank you, Sammy. Things are going well, and the market is keeping things interesting lately.
There was no sell in May and go away this month, right?
No, May was a good month for stocks around the world, and now, early June we're starting maybe to see a little more volatility as I think Fed story continues to unwind with the direction of rate policy and the fight against inflation. But May was a healthy month, and overall, I think looking at May, the market has been digesting a change in the Fed story of higher for longer. We started the year with the market looking for 6 rate cuts, and it's gone from 6 cuts down to about 1 cut, being what the market expected, and it just chugged up basically, despite kind of giving up on 6 minus 1, giving up on 5 rate cuts. Market still has performed well. Looking at stocks.
Yeah, do you have some numbers for us?
Yeah, I'll just run through trailing 1 month numbers for listeners for what's happened lately. Looking at the U.S. equity market, Russell 3000 up 4.7% over the last month. So that's a strong return for 1 month in U.S. stocks. So MSCI World ex US, so this is foreign developed markets, up 3.8%, and emerging markets up 0.56%. So positive returns across the board, led by the U.S. Leadership has been a little more narrow of late. AI has been kind of the big story, the big theme. NVIDIA continues to beat earnings. They had a good release recently, and they announced a stock split. Maybe we'll touch that now, which seemed to help propel the stock a little bit. So that's been a leader in the U.S.
So, Bob, the Russell 3000 is, again, just as a reminder for our listeners, compared to the S&P 500 or, another index you would track?
Yeah, Russell 3000 is 3,000 stocks in the U.S. It's pretty much the U.S. total market. It's cap weighted. So the largest companies by market cap count the most compared to the smallest. S&P 500 is basically the largest 500 companies. S&P has some criteria, looking at profitability. There's a few things to kind of make the list. But in essence, it's mostly the largest 500 companies in the U.S. So the big companies are the S&P. Russell 3 is the total market. We tend to look more at the total market.
The total market, if it's cap weighted, Bob, do they tend to perform in line with each other most of the time?
Long term, yes. And actually, Russell 3, over time, we expect to outperform, but month to month it'll vary. But even just looking month to month, S&P was up 4.96 over the last month, and what I said, the Russell 3 is 472, so you're pretty close there.
Well, let's dive into that real quick, Bob. Why do we expect the Russell 3 to do better over the long run than the S&P 500?
If you look at it, S&P 500 is the largest companies, and we do expect over time there to be rotation amongst winners. So small and mid companies grow up and become large, and large companies eventually fall down and cease to exist over time. And you see that in history. And by owning the Russell 3, you're getting the small and mid companies. And the kind of in theory there, you'll get some diamonds in the rough, like needles in a haystack. If you even just indexing, you're owning a wide range of the market. And you will have, tomorrow's winners in your portfolio when you own the Russell 3, as opposed to only betting on the companies that are already the most expensive in price.
Yeah, that makes a lot of sense. So, Bob, you also wanted to touch on valuations a little bit, just in terms of what I would imagine different stock market indices.
Yeah, and actually, before we just jump to valuations, I didn't talk about bonds. So let me just look at at least the Bloomberg US aggregate. It was up 1.7% over the last month. So that's been interesting. Year to date, the aggregate index is down about 1.6. So it's come back, kind of cut its decline in half. So we saw rates rise over the course of the year, and then they kind of peaked and started to decline in May. So little appreciation there. So maybe using that to pivot to valuations. Overall, interest rates have increased this year. So the 10-year Treasury today, I think it's around 4.4%, and stock valuations have increased. So if you look at the S&P 500, it's trading at about 27 times earnings. So 27 times earnings, which is pretty high. If you
Is
look
that forward earnings, Bob? Trailing earnings?
trailing,
What is it? Trailing earnings?
trailing earnings 27.4, I believe. And if you look over, say, the last 10 years, for most of that period, if you take out like the COVID 2020 blip when earnings fell dramatically, it's traded around 15 to 20 times, mostly closer to 20 times earnings has been about an average over the last, 10, 15 years. And seeing it at 27, that is pretty elevated. And then you pair that with higher than average interest rates that we've seen when you look at what's called relative value, basically comparing two asset classes, stocks and bonds. Bonds are more attractive if you're just looking at the yield, and stocks, if you're looking at the price you're paying, are on the high end of expensive of what we've seen. So that's something we're looking at, and the natural trade there would be to trim a little bit from stocks and add to bonds, and that's something that the investment team is talking about at this time.
That's just U.S. valuations, though, Bob. Are there cheaper opportunity sets globally outside of the U.S.?
Yeah, the US is more the outlier in the data. Overseas, it looks more like average. There's
Okay.
nothing that is really strongly signaling, really expensive or really cheap for that matter. Foreign markets, I'd say, just look broadly more fairly valued. It's the US that is looking a little stretched.
Let me push back on you a little bit, Bob, or maybe kind of stress test the mindset with what you guys are thinking of. I think it's you who taught me or told me that valuations can't really tell you much in the short term, right? They're not necessarily a trading or an asset allocation changing mechanism. So why bring it up? Why are you thinking that valuations in the short term right now may be causing you guys to do some portfolio shifts?
Well, yeah, it's a good question, and it is tricky. If you look at valuations, they have very little indication over results over the next 1 year, but they are actually fairly meaningful over the next 10 years.
Okay.
So if you're a long-term investor, if you're patient, in the end, they do matter if you give it long enough. But if you're the shorter the time horizon, the less meaningful. Like take it to an extreme over the next minute. Like what's the stock market can do in the next 1 minute? Who knows? It's flip a coin basically. But the longer you give it, the more the fundamentals matter. So yeah, that's kind of the risk that you could say market's expensive. Let's take some risk off the table, buy bonds, and then a year later you look like a fool if it goes against you. But that's definitely in the cards, the risk you're taking. But over time, valuations do matter.
Valuations matter. And so when you're looking at trailing earnings, is there a possibility that corporate earnings growth kind of catches up and makes that valuation metric more reasonable or cheaper?
Absolutely, there's a chance. I think it does bring up a good topic. So when you look at stocks, I'll just go off on a little bit of a tangent here. When
Sure.
you look at stocks, the most common valuation metric is the price to earnings ratio, or PE. So it's simply the price of the stock or the market, whatever you're measuring, divided by earnings. So the price is always the current price. The most recent price, maybe it's month end, but it's the current price. The earnings question is, well, where do you come up with the earnings? And there's two common ways to come up with earnings. There's trailing 12 month. Commonly, you'll see like TTM, trailing 12 months. So take the last 12 months and what did the company earn? And so that would be a trailing PE. And then there's a forward PE where you take analyst estimates and say, What are we expecting the company or the market to earn? What are we expecting earnings to be over the next 12 months? And that's a forward PE. So you have trailing PE, forward PE, and you can debate which one is more useful. I quoted a trailing PE, and you're saying, yeah, but if the market's growing, if companies are growing a lot, that's old news. And if earnings grow, then the PE can come down, which would be a good thing for valuations. And that's very much true. The issue with forward PEs that you see in the textbooks is I mentioned it's based on analyst earnings, and analysts are typically optimistic, expect earnings growth, and therefore forward PEs look lower than trailing PEs until you hit a recession, and the earnings estimates never expect a recession.
Yep.
So if you just look at forward PEs at market peaks, things are always looking rosy. And then by the time the earnings estimates are adjusted, it's way too late. So whereas when you look at trailing PEs, that's real numbers. Those are earnings that are in the door. There's no guesstimates around it. So we do prefer to look at trailing PEs because the guess in the future is just that and assumes a rosy future.
Yeah, it sounds like that's a really thoughtful way of going about it. Neither one is perfect, I guess, is what you're saying, which is kind of
Yes.
walk me through. And I would imagine advocates of either approach are aware of, the other side of the topic, or people who focus on forward PE are aware of trailing and vice versa.
And I would even say, kudos to you for calling me out on it. Whenever you read something or you hear someone reference a PE, if they don't say trailing or forward, ask or look for clarification because
Right.
the forward will be lower and the trailing will be higher. And people use them interchangeably, but they are different and you can kind of use them to tell a story. So but it is important to
Yeah,
know.
and that's not what we're doing. We're using them to try to make good investment decisions for our clients.
And
But
that's why
yeah,
we always look at the trailing. Yeah.
when you're watching on TV or reading somebody's viewpoint, they can present things in different ways anecdotally to make their case a little bit stronger than it otherwise would be. So May performance was good, valuations, some interesting stuff there. Potentially the U.S. equity market being a little bit stretched and yields on fixed income more attractive. Global equity valuations or international equity valuations more attractive than the US. It's stuff we've talked about, right? So I would imagine it's not going to drive major portfolio changes or shifts, but it's interesting that you guys are thinking about it. We touched on this briefly when you mentioned Nvidia. This article that I shared with you, it was from Sherwood News, and it was why do companies do stock splits? And it's basically, I'm sure Nvidia driven, right? Because almost everything that people seem to think is interesting these days with the stock market is Nvidia. That so you have a stock split. What's a stock split? It's really not shouldn't be an event. It's basically taking a pizza, and instead of having 6 slices or 8 slices, now you have 10 or 12 slices, and so there's not more pizza. It's just chopped up into more pieces. So cynics will look at stocks that do well after a stock split and kind of snicker and say, these crazy, foolish retail investors, don't they understand it's still one big pizza? Nothing's changed. Why do stocks do well after splits? I found this article interesting because it talked about something I wanted to get your opinion on, not slices of pizza, but this idea that companies split their stock when the stock is doing well. And so when stocks are doing well, they continue to do well. There's momentum in the markets. So it became kind of a more rational explanation for why you see this stock split phenomenon being good for a stock. It's not really because of the split. It's more because of momentum and who's choosing to do a stock split. So probably the longest prelude to a question I've asked you since we started doing this podcast, but can you explain a little bit this concept of momentum, which I know we believe in and we acknowledge exists in the market, and how it could be driving some of these things we're seeing?
Sure. So momentum, simply stated, is winners keep winning and losers keep losing. That's really what you look for in momentum. And the data does show that it tends to work. It's not perfect, and momentum reversals can be nasty. Is kind of the downside of it. But if you have two companies and say one that the price is going up and up and up, and the other one the price is going down, 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 it's better if you look at the historical data, like better than 50-50 odds that if you have to pick between the two, you pick the one that keeps winning. It is more of a short-term trade. So you see this is more the quants, the hedge funds that are in there, and they're looking for the momentum to break. And as soon as it starts dipping, they'll get out. But that's momentum in a nutshell. Winners keep winning, losers keep losing. And then you have momentum is similar to trend. And then you have what they call trend reversals, because eventually the trend breaks and what goes up comes down and what goes down comes up. But it's just trying to kind of ride that. Because if you think of a chart of a stock or a stock market, you do see little trends in it. It's not like one of those like EKG heart monitor things that just like bouncing all over the place. It trends. It goes up for a while like a bull market, goes down for a little while a bear market. So those are many trends. So active investors, like the article you referenced, I think AQR was quoted in it. They look to try and go long in the bull market when it's trending up, and then go short in the bear market when it's trending down, and that's riding the momentum. So how it relates to stock splits, a company typically is splitting their stock after the price of the stock has gone up a lot. And like for reference, I looked back at Cisco, kind of the king of the tech bubble, and they split their stock almost every year in the 90s.
Oh, wow.
There was a 2-for-1. It was literally almost every single year, with the last stock split being March of 2020, and then the stock
Hmm.
crashed. So it's one of those things that a stock split in itself is a sign of a stock that's appreciated a lot. It's a hot stock. And is that a good reason to get in it? Well, it is until it's the last stock split for a while. And then you probably have a pretty big correction coming. So
Yeah, no, that's a fair point. I definitely not advocating a stock split purchase strategy for people, but it was interesting to me to see another spin on it. And it's not just, people are foolishly buying a stock just because it's split and they just don't understand what that means. It's just that, winners keep winning for a while. And so when you split it, maybe it's going to continue most of the time until it doesn't, right?
yeah, it is interesting because so momentum is what it is. It's been known for a while, the momentum research. What I don't have data to support this. This is more just my instinct as an observer of markets. I do feel like in recent years, stock splits have become more of have received more of a positive, result from markets, that to a head scratching degree, like, oh, we're announcing a stock split and it goes up 5 to 10%. And here we're talking about you just cut the pizza in a few more, rather than 6 slices in the pizza, there's 12, but you're getting your same 2 slices instead of one. It does seem to be a little more, a bigger reaction than you'd expect recently. And so I do think there might be some of those meme stock traders out there doing
Yeah, no, fair enough, for sure.
head
Yeah,
scratching
absolutely.
things. Oh, you got to buy because it's buy one get 10 is the Nvidia sale that's coming on Friday. It's a 10-for-1 stock split. So if you have one
10 for one.
stock today, you're going to get 10 shares of it. I think it's Friday. Um, I feel like there's probably still a little bit of that, which is just kind of mind-boggling.
Yeah, absolutely. No, I wouldn't disagree with that for sure. So the last thing that we wanted to touch on is what we're seeing in the real estate market, the residential real estate market. I think you brought this up, and I've also seen in some of the stuff that I'm reading and sharing when I can too, that the residential real estate market is slowing.
Yeah. Yeah, I'll just run through some numbers. And this is key because, one, I know a lot of our listeners are interested in residential real estate. Most people have a house. Some people have two or three even. So they're just naturally curious. But it's also very important because shelter housing cost is really the main component that's keeping inflation elevated above the Fed's target. We've seen a lot of progress from the Fed, but they haven't really been able to break housing and get it to a level that contributes more at the 2% rate. Like even, recently it'd been increasing at about 0.5% a month. And one thing with housing is that the data is a little delayed because, as you know, you make an offer, sign a P&S. By the time you get the transactions through, we're looking at lags. So we recently received the March Case-Shiller home price index, and the month-over-month increase was 0.3%, which is better. It's not 0.5, so getting closer to the 2% run rate. But then looking at things like inventory, the number of homes listed for sale in May of this year, it's 15% higher than May of last year. So part of the story with real estate prices being high, it's been, well, there's no inventory, no one's moving. Mortgage rates, people have their 2 or 3% mortgage and they're not moving. So there aren't houses on the market, but inventory is higher at this point, or in May of 2024, than any of the three prior Mays. So, seeing inventory up is a good thing. And then with that, there's more price cuts than any of the last 3 years. So we're seeing more houses listed, more price drops, and then as far as quick sales, so houses that go under contract within 2 weeks, it's the fewest amount of houses that it's listed and it's gone. That kind of hot market that you see, that's at the lowest rate in the last 4 years if you count this year. So those are all signs that you see with a housing market that directionally might be cooling. So thought that was, from an inflation perspective, good to see and interesting, because we've just been in such a stubbornly strong housing market that it might finally be turning.
Yeah, I saw a report from the National Association of Realtors that pending sales slumped 7.7% in April, and it was all regions, including ours in the
Yeah.
Northeast. So, yeah, you put that together. I do think it's interesting from an inflation standpoint. Does it have an impact on the economy, Bob?
It should. I mean, housing's complicated because when you think like what's behind that, is that a weak consumer? The consumer doesn't have as much money to buy, so I would say it's, well, yes, it can have an effect on the economy just in transactions too. Like for example, retailers like Home Depot do well when there's a lot of transactions, and when there's fewer, they don't. But I think it's also indicative of the health of the consumer. And we are seeing, let me see, I think I have a chart on this too, some more concerning data on the consumer. So just transitioning to jobs, the Conference Board does a survey, and they ask, are jobs plentiful or are jobs not so plentiful? And the jobs plentiful reading was the lowest since early 2021, when we were coming out of COVID. So it's been on a pretty decent decline. And the jobs not so plentiful, that was the most highest it had been since that period as well. And that goes kind of hand in hand with the hard data from the JOLTS report that we look at job openings, and job openings continue to decline. So that's showing further weakening in the labor markets, or softening. So it used to be there were two job openings for every one person unemployed, and that ratio continues to go down and down and down. So we are seeing some weakness in the labor markets. And if you say translate that to, well, what would that mean to the housing market? Well, you probably have fewer people making big quick offers for houses. So I'd say housing conditions are probably more of a symptom of what's going on in the underlying economy than a driver of it, if that makes sense.
Yeah, absolutely, it does. Anything else, Bob, on your mind, or you're talking to your team about as we head into the summer months here?
No, I think just kind of the theme is we've been talking about the Fed and inflation, and I think we're getting towards the end of it. That inflation has been sticky at around the 3% level, depending on how you measure it, but we're seeing signs that the economy is starting to slow through various data points like the ones we shared. And inflation, it's time to come down in the next couple months, I think. So we'll see if we get the soft landing, but yeah, that's something we're watching closely.
This is probably getting into dangerous prediction territory, but does that mean that rates would come down a little bit?
Yeah, the expectation right now, markets have come down to close to one rate cut, as I mentioned earlier, and I think it's at the September meeting. So that's what markets priced in. But if we see inflation, I think the Fed is probably getting more and more ready as they're seeing the softness in the labor market. They just need to see a couple of good measures on inflation, and then they'll cut.
All right. Well, thanks, Bob, for that overview. I thought it was a great conversation talking about what's going on in the markets, valuations, how to think of that, residential real estate, stock splits. We touched on a lot. I appreciate your time.
All right, thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.